Hi, Dan Kurz, DK Analytics. It is February 8th, 2018. Thanks a lot for tuning in. We'd like to reappear in audio in a video format here, audio, video, both, and talk about something I think that is very timely, also given the increasing volatility, still minor yet, but increasing from flatline. With a VIX that was comatose to one that's perking up in terms of reflecting increased market volatility. Again, very low still, but and by the way, let me just say one thing about market volatility before I continue. We've had so little of it for so long, thanks to financial repression at work, thanks to plunge protection teams, thanks to coordination by central banks, and all this other wonderful stuff that has pushed aside price discovery, including, threats, quote unquote, of purchasing stocks or bonds under duress, and then obviously going out and purchasing billions and trillions of them over the last decade or so. So this has rendered our pricing mechanism or price discovery academic, but it hasn't rendered economics academic. That is the earnings that result. And our little audio here, our little audio video is going to delve into that very specifically from an interest rate perspective. We know that thanks to financial pressure, huge money printing, QE, central bank balance sheets have bloated by about $15 trillion over the last decade or so, a mind-bending amount. And that has obviously conspired to hold down interest rates because they've bought bonds of all kinds, mostly government bonds, but also corporates, and if the Swiss Central Bank and the Japanese are included, they are even up in front about going out and buying large amounts of equity. So they've pushed up the value of financial assets, bonds, and thus stocks very substantially. This is a mystery to nobody, but what might be a bit of, not a mystery, but a wake-up call is what happens if the global central banks lose control and the bond vigilantes come back, or we get reversion beyond the mean from boom levels, bubbles, very low yielding bonds, and very low earnings yield on stocks or high PEs. What happens if that switches and you lose control and economics and financial concerns push aside politics and the monetary imaginations of central banks, which are obviously highly political in and of themselves? Don't let anybody tell you any different. We put out a post on this on January 18th. It's our 25th post. We tabulated it, or called it interest rate impact on Standard & Poor's 500 net present value. Why is this so important? Because net present value is the market's way of valuing something based upon two big things: expected earnings per share, this is based on the S&P 500 or any stock index or any stock. On the one hand, what kind of EPS are we going to have, what kind of EPS growth, and how do we discount those projected future earnings per share back to the present? And that discount rate is the very big thing that right now is under a lot of question. In other words, it's in doubt whether it can stay as long as it is. Why is it this low? Because the discount rate is for stocks, which are long duration assets. Blue chips are ultimate duration assets, in fact. And 10-year bonds are long duration assets, especially given the low coupons, or not the low coupons, well, the low coupons and the low yields. And 30-year treasuries are also long duration. That just simply means that a large percent of your projected returns are in the future. And the further they are in the future, the more an interest rate change increases or decreases the value, the present day value of those far off in the future earning streams, or earnings which in the case of blue chip stocks are expected to continue over decades because they are blue chips. So that is something that we're trying to get our arms around here in an audio video format as a complement to post number 25. Before we go there, let me give you an example, and then in the bond arena. In the bond market, roughly 3-4 times the size of the stock market. You can expect that given the debt binge we've been on. But the bond market, if we take the 10-year Treasury, and I'm sorry, if we take the 30-year Treasury, we're using 30-year Treasury here. Why? Because it's closest in terms of duration when the average return is from investment to blue chip stocks. In fact, blue chip stocks have an even longer duration, but this is the closest thing we can use. The 10-year Treasury is the benchmark upon which all other interest rates in the capital markets are based. That is, 1 year and beyond tends to be determined by the 10-year, 5-year, 10-year, and mortgage rates and all that is priced off of a 10-year. And the 10-year bond, that is the yield on it, is assumed to be, for much of the world, the risk-free rate, the benchmark. And everything is supposed to be riskier than lending to the U.S. government, and then you end up having risk premiums for solvency or inflation concerns, and they then come together in stocks to give you a discount rate, meaning a discount rate is a 10-year for a lot of people, or in our case, we're going to use a 30-year Treasury yield plus a premium because corporations can't raise taxes and print money like the government can, all right? So here's what those 30-year bonds look like. We know we've been in a huge bull market for about 35, 37 years, and damn near 4 decades in bonds. And if we take today's 30-year Treasury, it's yielding 3%. It's been in double digits before, all right? So we're way down in terms of yields, way up in the price of a 30-year Treasury. And let's move around interest rates a little bit. Remember that, well, today it's the 30-year Treasury yields 3%. If you brought it out, it'd have a coupon of 3%, and yield to maturity would be 3%. It would price out at 100. It would be due in 2048. Now, let's say for whatever reason, in greater solvency concerns for governments, much less corporates or mortgage or whatever is priced off of the 10 or 30-year U.S. Treasury. Let's say that solvency concerns and inflation concerns and inadequate yield concerns, or simply loss of control of these asset bubbles by the central banks for whatever reason, by bond vigilantes or nations getting out of the dollar and going into their own currencies or into gold or what have you. Let's say, excuse me for a moment, that the 30-year Treasury at 3%, and again, it's been over 10% in the past, right? Let's say it goes up from a 3% yield to maturity that is needed to 5%. Not that high of an increase if you think of the long-term yields on offer, but you bought it, so your coupon stays at 3%. So the market demands, say, a 5% interest rate. You're locked in with a payment of maturity to 3. You bought it at 100 when interest rates were 3. They've now moved to 5. Again, your payment to maturity stays there, but the market demands 5%. What do you think happens if the 30-year long bond goes from a 3% yield, the market demanding 5%? Where is the price of that bond? Would 69.1% surprise you? From 100 down to 69.1. That's a 31% drop. Let's say that markets, and again in post 24 we go through reversion beyond the mean, from boom to bust and bust to boom. We're in bust valuations in bonds and stocks and real estate, just about anything save for very select items, including precious metals. But let's say that given this binge that we've been on with money printing, reduced property right protections, cronyism, misallocations furthered by all that, and the incredible increase in global debt, let's say, and the threat of heightened monetary inflation risks thanks to all the money we've printed, and the need for central banks to double down if this whole thing comes unglued to support asset prices. Let's say that the market will not demand only 3% on 30-year, but 5%, and let's blow past 5%. And let's say the market is going to demand a return from treasuries or a yield that is 7% instead of today's 3%. But again, we're stuck with a 3% payment to maturity. Why then, the value of that 30-year bond, just going from a 3% required yield on a 30-year today to 7%, which would be far lower than we've seen, even though we're in a much worse situation today, whether economically, whether financially, whether politically. Let's say we go to 7%, then that value of that bond would be literally cut in half. Now, let's turn back to stocks. Let's turn back to the Standard & Poor's 500, the blue chip index of the world, if you will. And let's assume that those same interest rate increases get dialed in, if you will, to discount rates. Let's say that discount rates are going to reflect higher interest rates based, one, upon an increase that people are going to demand if they lend the U.S. government and other governments, by the way, money. All Western governments, with few exceptions, are broke. There's yield deprivation and financial repression throughout the world. So I'm not picking on the U.S. I'm just highlighting it as the leading engine, and because this is a U.S.-centric site here, but we live in a global world, so expect all these things to travel together. Bonds go up and down together, and stocks do too. And stocks are tightly interlaced with interest rates or yields that bond investors demand. If we take a look at the current S&P 500 valuation, I'm looking at midday, February 18th of 2647, and we assume a discount rate, again, a 30-year of 3% plus 1% for a risk premium, because equity holders obviously get paid last after creditors, after employees, and they have to absorb the ups and downs of recessions, which get exaggerated at the bottom line. I'll get into that in a second. But let's say that we just priced today's Standard & Poor's 500 at a 4% discount rate for the first decade going out, and then we moved to 5% in the second decade and 7%, reflecting an increase in interest rates, albeit very slowly and artificially, but to just take some of the fever out of the valuation of the stock market based upon today's assumption that we're going to have low interest rates forever. If we did that, okay, and made some assumptions about earnings progressions over the next 3 decades, then the value of the Standard & Poor's 500 wouldn't be 2647, but 1,696. It would be 36% lower than today. If we, in turn, tighten the screws even more and said, oh, we're going to have much more problems with solvency, with inflation, with drooping productivity, with misallocations, this wonderful toxic public policy stew, and we're going to require progressively higher interest rates over time. And we dial those in, and the 4%, 5%, 7% discount rates over the first decade, the second decade, the third decade, and after that we kind of put it on a sustained level with no growth given the aging aspects of companies. But let's say we move to 8, 11, or 13%. And en route, we nudge it in the first step up from 4, 5, and 7 to 6, 7, and 9. Well, if at 4, 5, and 7, making some sane EPS growth assumptions, yields a market that would drop by 36% from today, if we dialed in higher rates, given higher uncertainty, higher risk premiums, higher rates meaning higher Treasury yields, we would see a market that would fall roughly 57% from today's valuation. That is, instead of 2647 on the S&P 500 intraday today, we'd see something like 1,127. That's 57% less than today's valuation. If we tightened up the discount rates, again on the back of higher long bonds and risk premium increases to 8, 9, and 11%, which wouldn't be at all abnormal given what's happened during periods of low productivity or high inflation and high debt before, but we're going to blow through all of those, unfortunately, in a negative sense. But if we valued the S&P and made some assumptions about the next 3 decades of earnings, which I'm going to get to in a second, it doesn't sound as insane as it does at first glance, then we would have an S&P 500 that would have nearly 70% downwards potential from today. And this is the susceptibility to a large loss of capital that shareholders are exposing themselves to. In bonds, if you stay on board and they issue a 30-year bond yielding 3%, and that's what the market demands, you're at 100. If we go from 3 to 7, you've lost half your value. You're stuck. This can happen quickly, and you cannot avail yourself of 7% interest rates without losing half the money on your 3% bond. All right. It's the same thing with stocks. That's why you take money off the table. It's called capital preservation. Let me now delve for a second into the earnings per share dynamics, the other side of this equation, this net present value calculation. Over time, earnings per share are not going to grow faster than nominal GDP. Right? That's a given no matter what country you're in. And I'm talking about over decades or 50 or 100 years. It just isn't possible. You're not going to have shareholders grab a progressively larger share of GDP, nor is labor, nor is government. They're going to balance each other out. We're at a high point, by the way, in terms of what shareholders are extracting as their share of GDP. And that too is a question mark if that can continue. But let's take a look at historical earnings per share growth. If we go from 2006, a high point on the Standard & Poor's 500, something like $82 a share, and we reached 117, another high point probably at the end of last year, then what we've got through the recessions, okay, through the recession that we had after 06, 07, 08, and then the recovery where earnings first fell off the map, got squished, and they actually went down by 80%. All right, they went down by 80% because we had a lot of big bath accounting, lots of overdue write-offs, lots of M&A, lots of bad will instead of goodwill. And I don't think it's going to be any different this time. I really don't, especially given this poor quality growth that we've had, whether it's weak GDP growth, whether it's lacking organic growth at the corporate level. We've had, in essence, financially engineered growth through stock buybacks, through cost reductions, through outsourcing, but not through plant and equipment, CapEx, and top-line growth, right? So, and in the same time period, we've had over the last decade a decline in global productivity, U.S. productivity as well. And there's a big tie-in. We've had an increase in global debt at all levels. And that is tied into an economic growth that we don't get through productivity, that we have to borrow. And that's why we're getting such huge increases in debt. So the quality of our earnings this time around, our corporate earnings, are less than they were because of the nature of the corporate earnings on the one side and given the macro and the financial and the political situation on the other. Macro, weak economic growth. Financial, we're much more leveraged than we ever have been. Political, we have less stout property right protections, right? So it could be a lot worse going forward. But for the sake of looking into the future at some kind of sensible growth rate over the next decade, and then a decade after that, and then take one more and then kind of put it on autopilot. If we take that and assume we're going to have similar recessions in the future as we've had in the past, using our most recent decade as an example, then over the next 10 years, instead of having 3.1% is what I think I got, EPS growth from 06, from our last earnings peak, to 17, a little bit more than a decade, but I'm trying to use representative numbers or goalposts. We had 3.1% there, and over the ensuing decade, where we've got all these issues of productivity, debt that suggest weaker GDP growth, weaker EPS growth, we've got over the decade 2.6% expected growth of the S&P 500. These are nominal numbers versus 3.1% over the last 11 years. And the decade thereafter, in 27 to 36, our model is going to come up with 2.4% nominal earnings growth, earnings per share, and then down to about 2% in the third decade. So these are the numbers that are really, I think, sanely based in their gap. They're after big bath accounting. They reflect recessions, which haven't been rendered obsolete. We're going to also see a strong spring back, just like we did see in 09 and 10 in earnings per share after big bath accounting. But even with that spring back that we had in 08, 09, between 06 and 17, take two peak years to get a fair, yardstick on either end of the bookshelf, we had only 3.1% nominal earnings per share growth of the Standard & Poor's 500, 3.1%, which is not too different, our point, from nominal GDP growth over the same period, which was something like 2.5%. Going forward, if anything, given our economic, financial, and political situations, is not going to necessarily be better. So we're giving it a bit of a haircut, and the slowdown from 3.1 over the ensuing decade to 2.6, and 2 decades out, or the second decade out, to 2.4 and then to 2%. Meaning that if we go from 17 to 46, the 3 decades, we're going to take those and compound those earnings. They're going to take a hit near the beginning for a recession because you haven't rendered them academic. We're way overdue for one, and we're going to have a stout yet fleeting strength in earnings recovery after big bath accounting, and then chugging along more or less at GDP growth rates. If we do all that and throw it in with those interest rate, discount rate assumptions that I told you at the beginning, no matter how one slices it, today's Standard & Poor's 500 market is likely overvalued by at least 36%, meaning we use only a 1% increase or 100 basis points over the 30-year Treasury as a risk premium, right? The market, with throwing in a realistic earnings per share growth of the index, I would argue today at 26.47 is fully 36% overvalued. If we ramp those interest rates up over the decades, that is the discount rates, which is the 30-year Treasury plus risk premiums, from 4, 5, or 7% to 6, 7, and 9%, then today's market, with our roughly 3% and 2.5% EPS growth potential over the ensuing decades, is roughly 57% overvalued, 26.47 compared to 11.27, assuming we have about 2.4% and 1.95% growth in the latter decades, and we have discount rates of not 4, 5, or 7, which are historically very low for stocks, but 6, 7, and 9, which are closer to where we should be if we didn't have this dramatic hole to fall into that we've dug ourselves. But that would then yield an S&P of 1127, which is fully 57% below where we stand today. I think that is pretty representative of what fair value would be. And that 57% loss, like in bonds, if you stay on board and the shit hits the fan in terms of recession and bond vigilantes and all this other fun stuff, I think you could see a 50% plus reduction in the value of your S&P 500 index holdings quite quickly. And frankly, it might not end there. Again, we don't have reversion to the mean. We have reversion beyond the mean. I'm talking about we're overdue after a 38-year bull market in bonds, and given all the debt and the misallocations and the money printing and the reduced productivity, we're actually due for a substantially higher return to offset the higher solvency and inflation risks that we've built thanks to our policy, our toxic global public policy stew. And if one dials that in to today's Standard & Poor's 500 at 2647 midday and uses 8, 9, and 11% discount rates. And remember, we've had 30-year bonds higher than that, substantially, all right? Then we get a market that would be fairly valued using our 3%-ish EPS growth assumptions roughly over the next few decades. We get a market that should trade at 8.58 at those kind of discount rates, 8, 9, and 11% each over the ensuing decade, 8 the first decade, 9 the second, and 11 at the close. We would have a market that would trade for 858, the S&P, instead of 2647, which would be nearly 70% loss. That would also bring us back into, as we go through and post 26, a situation where our dividend yields or our earnings yields on stocks are going to look a hell of a lot more attractive. And that's when nobody's going to want to buy, and those will likely be bargains. And to close out, we have one huge disclaimer. All this wonderful stuff, in other words, leveraged output, earnings that we're creating, is in essence based upon adequate, around-the-clock, 24/7 energy, dense energy, fossil fuel-based energy. If you take oil, gas, and coal, you're talking about 85% of our global energy supply, right? That's it. That's what it's all about. And they're the only ones that are available around the clock, 24/7, not when the wind blows and the sun shines. If we lose access to those, or the price of those goes up a lot, and if we go to the biggest cylinder still, declining but still biggest, oil, with roughly 32% of our global primary energy supply, and we lose that, then we lose the ability. And natural gas is oil's sister. They come out of the ground together. But if we have increasing troubles unearthing oil and natural gas, given field depletion, elephant fields, which we can't find, fracking, which is a joke economically, and probably also in terms of environmental damage that happens, if we lose access to affordable 24/7 dense energy. And if you take a look at how much, and we go over this in post 24 as post 25 as well, this is on the interest rate impact on the S&P 500. If we lose access, or we have to pay a lot more for fossil fuels, be it oil, natural gas, or coal, or we are in a situation where the price drives out end demand. That's also possible. We will face a situation where the earnings and even economic growth which is truly, over the last 200 years, a function of a lot of energy slaves working for us, meaning that barrel of oil, right, those 44 gallons or 42 gallons or 160 liters, is the energy equivalent, meaning it generates the heat to drive pistons and turbines, to power our tractors, our locomotives, our cargo trains, even turbines in some instances. If we lose access to that or can no longer pay for it, then we cannot have the leveraged output that brings us the earnings power, much less the GDP output or growth. So what I'm trying to say is there's an Achilles heel to all of this, and that is all these relatively benign assumptions of continued economic growth, despite all this toxic public policy stuff, is something that banks on available energy. And if we take a look at oil finds and oil replacement rates, we're using 3-4 times as much as we find. We've got massive field depletion around the world. Oil is the most important aspect of our primary energy supply, together with sister natural gas, from fertilizer to tractors and everything beyond. And let me give you one, for instance, to get you more comfortable with just how dependent we are on available, affordable, 24/7 energy. Two statistics, really. The first is this. If 1 barrel of energy converted into heat, right, in machinery, in engines and turbines, is the equivalent, work equivalent of 1 agricultural laborer toiling in the fields for 11 years, or 1 horse hitched to a plow for over a year. That's how much energy leverage we're getting. That's why we've had the economic growth and the population growth and the ability to feed people. All right? Natural gas is what got us Haber-Bosch. That's the process where we've got all these yields that wouldn't have been possible before. If we lose, the other example, just 5%, an hour and 20 minutes a day of power. And power is basically coal and natural gas based, right? They spin turbines, they're hooked up to generators, and we have power, and it's very reliable, and it allows this huge leverage that we talk about with the oil barrel equivalent, the same thing. If we lose just 1 hour a day of power, then studies have shown that the economic output collapses by about 50%. What's our point? What's our takeaway? Our whole relatively benign scenario for bonds and stocks depends upon an adequate and affordable supply of dense fossil fuels, which are then used to leverage output massively and create these earnings, for which we can then distribute to shareholders, and before that pay our creditors with. And that is not such a sure thing. So you also want to hedge your bets strategically for losing that and then not being able to have the GDP growth of the earnings or the money to distribute to creditors. If we lose that, then we also have to turn around and say, what asset, if any, is a net present value of costs already expended? And that asset is gold, physical gold, and silver, which also happens to be money, medium of exchange. Why? Because the energy's already been used to pull it out of the ground. It's not something you have to do in the future. It's the future value, all right? It is the accumulation of the work and the energy and the labor and the capex associated with the mining has already happened. So that's such a contrast to stocks and bonds, which depend upon future earnings streams. So with that as a parting thought, I thank you very much for listening. I hope you got something out of this. I suggest you take a look, if this interests you more, at post 25, where we go through these numbers with the interest rate impact on Standard & Poor's 500 valuations. And post 24, we go through reversion beyond the mean. And our very latest one, if I can make a little plug here, is post 26, and that's President Donald Trump's State of the Union, in essence, greatness financed by more debt. That might be an interesting read for you as well. I'm going to sign out herewith. Thank you very much for listening. Bye-bye.